connecting. All right. I think we're all ready. We're live. So, hey everybody. May take a minute or two for some viewers to come in here, but we put this out on a link on Twitter and Substack, where I'm talking with Nam with Harbourfront newsletter on Substack. We each have our own Substack newsletters. I'm Safe Harbor Stocks on Substack as well. I pretty much write about different investing concepts, investment analysis on specific stocks. I also talk a bit about options, and I've written some articles on that. So there's a nice intersection between Nam and myself. As far as options, he's a pretty good, smart quant, much smarter than I'll ever be with that stuff. And so we enjoy talking about those things. We have good overlap with some of the work he does and on the research and systematic side. And we're going to have him here as well to talk a little bit about more beginner and maybe intermediate level, depending on if anyone has any questions on using options for traders, investors in their portfolios. So, Nam, thanks for being here, and I'll let you introduce yourself.
Okay, thank you, Kris. So my name is Nam, and I'm a quant. And then I have a newsletter focused mostly on quantitative research, mostly in the options and algorithmic and quantitative trading space. And then, as Kris said, we have our expertise have a lot of overlap. So today we decided to join force and to do webinars on volatility and options and trading. Yeah. And then, so this first webinar is geared towards more to the beginners. But if you are at a more advanced stage, then feel free to ask questions, and then maybe we can do another follow-up webinars for more advanced audience.
Yeah, sounds good. Thanks, Nam. And if a lot of people I know, the first time, this is the second stream I'm doing. The first time I did this a day or two ago, I think a lot of people joined on X, which is totally fine. That's streaming there. It may not be functionality to add comments. So if you want to add comments, ask questions to Nam or myself on anything, feel free to use the YouTube link, and you should be able to access the stream there. And I believe you'd more likely to have comment functionality there too. So feel free to do that. And I think we'll just maybe get started, and I'll pull up, I think, Nam, you have some slides I'll pull up for you.
Yeah.
And you can just give a little intro on options.
Yeah, so I guess that most of us here, even the beginners, so now we know the concept of like the puts and calls options. So I'm not going to get into this, but just to let you know that trading options probably the most important factor. The most important variable to consider is the volatility. So unlike the other lengths here, we have to deal with volatilities. And there's now is a very, very well-known concept in the option trading, which is called volatility risk premium. And then I guess most of you already know about this, but just a reminder is that the VRP is the difference between the implied and realized volatilities of options. And here in this graph, I shows the difference between implied and realized, forward realized volatilities for the SPX for the last 10 years. And then as you can observe that like most of the time IV minus RV is above zero, right? Except like during some market crashes, it went negative, but most of the times it's positive. This is where you say that people when you hear people people are saying that options are overpriced. And
So
yeah,
can
and
you
then yeah,
give
go ahead.
just a quick overview for some? I know some know, but maybe some investors may not understand it as thoroughly. Just the difference briefly between implied volatility and realized volatility.
Yeah, so implied volatility is the volatility is calculated using using the options prices as input, and then using the Black-Scholes merchant options pricing formula to make out the implied volatilities. So put
So
it
the
differently.
implied
Yeah.
is sort of what the market believes there's the risk, the potential for volatility and prices to go up or down for certain securities, and the
Yeah.
realized is more the historical, how the security is actually performed.
Yes, actually, yes, that's correct. The realize historically how the securities perform. But in this graph, I shifted the realized bond like forwards by 1 month. So just to compare, like the implied uh, volatilities at this moment, and the realize that the realized volatility a month from now. So this is what the graph is saying.
So what
And
you
then
know, what? Go ahead.
yeah, and then you can see like a big drop like in the VRP the risk premium during the COVID like at the middle of the graph.
So
Go
you had
ahead.
that large dip,
Yeah.
around COVID in early 2020, which is pretty much signifying the huge actual price volatility, right? When markets were
Yes.
shaken by COVID and the outbreak. So you have what that large dip means is the markets moved so fast. At that point, presumably more so on the downside early on, too fast that markets didn't really price in that implied volatility and price the options well enough because they couldn't see something like that coming so soon.
Yes, that's correct. Because at that times, like this was like a once in a lifetime opportunities, once in a lifetime market event. So the market probably didn't know how to price this event. So the implied couldn't reflect accurately the realized. That's why here you see that the realized volume is greater than the implied volume, resulting in a negative VRP. But usually in normal times, implied is greater than
Later,
realized.
yeah. Yeah, and you see that on
Yeah,
the chart.
but here one interesting I observed is that after the COVID, you see the before the COVID, like the graph is mostly vertical, and then we see that implies is greater than realized. But after the graph is after the crash, the COVID crash,
Mhm.
there's I see that there's the change in the dynamics of implied versus realized, and I don't know why it is. So it we would need like a more investigation and research
That's
to
interesting.
answer this.
So
Yeah.
what you kind of made a point, and because I can relate personally to it, uh, that the VRP, the volatility risk premium, is typically positive, right? It's above zero, mostly, especially in the last 5 years or so. And I know in some ways I feel like there's ways I take advantage of that myself, and I can introduce an article on the screen a little later. I wrote about
Mhm.
selling short puts, cash secured puts for some extra income and cash yield on my cash and money market funds. Can you tell people a little bit about what that small positive volatility risk premium means, which is really the implied volatility. So the price of the options are a little more expensive than what the actual price movement that we've seen historically. So that obviously means there's potentially some some opportunity or some alpha, some inefficiency to take advantage of. Can you explain what that means a little bit as far as the blue line being a bit positive?
Yeah. So the blue line is positive, meaning that usually the E line is greater than the realized, which means that the options price is usually overpriced, and then this will lead to like strategies like options selling premium, like and other option selling premium strategies like covered call, or more sophisticated like hedge butterflies, or hedge straddle, strategies like that. And then usually there's they have positive expectancies, except that in some cases these strategies have tail risks, so we have to deal with it. But
yeah, definitely, especially when you're selling stuff naked too. There's some there's always risk. There's that expression, picking up pennies in front of a steamroller, depending on
that's true.
what people employ. But there's also really good helpful strategies too, I believe.
Sure, absolutely. We are going to discuss shortly. So next slide, please.
Sure. Okay.
This study is a little bit more advanced, but as I said, I've been doing like some quant research, and then some research in quantitative literatures, and then recently there's some papers that came out, and that proved that the volatility risk premium is the reward that the investors are getting for bearing the overnight risk, not the intradays. So what implication this has is that if you try to sell premium, then sell it like when there's a lot of holidays, or sell it before the weekend. And then if you want to go long premium, like buying protection, then to do it like at the beginning of the week, right? So to avoid the weekend. But this study is pretty advanced. And then there's another paper that I didn't cite, but that said that the existence of this volatility risk premium is due to the fact that during the market closure, the market makers couldn't delta hedge and manage the risk of their books. So that's why they overpriced the options, and this has an implication that now as we are moving toward 24 hours trading, maybe this will affect the dynamics of this volatility risk premium, and then this will change affects the dynamics of all of this option selling strategies. Maybe they will not be as profitable as before, and maybe now and maybe in the future buying options or buying protections makes more sense. So investors will have more opportunities to buy and to hedge, to buy the put options to hedge their portfolios. But this we have to monitor and
you took the words right out of my mouth. I was going to ask the question about moving to 24-hour trading, because that's more and more of a theme. And I think the CBOE just released something this past week that they're going to 24/5. I think it is maybe
24/5. Yeah.
Right. So it seems to be a trend. So that's definitely going to have an impact. I guess people using these strategies, they may need to migrate to something else.
Yes, for sure. But maybe as I just said, maybe the VRP will decrease, But if this is the case, then the hedgers, those who buy, those who used to buy put
Yeah,
protections, they will be happy because now the puts will be cheaper, so the
that's true.
protection will be cheaper. So we don't
Yeah,
know yet. So yeah, something to watch out for, and then
that's
to do the research, to do the research. Yes.
yeah, that's a good point. I didn't think about that.
Yeah.
I don't, and maybe you're covering this in one of the, yeah, I think we have two more slides, but you're covering this in one of the other perhaps, but I was curious about the skew and the difference between put and call implied volatility and premiums. I know they're a bit different, but is that something you cover later or something worth mentioning now, just briefly?
Yeah. Just go ahead and mention. No, I didn't have. I didn't prepare graphs
That's
for
fine.
that.
Yeah, I just didn't want to preempt. I didn't want to steal your thunder for the next slide or something. So, but I know that's definitely because you have covered call ETFs, you have these, and my experience, as an investor, as a trader in the past, is obviously there's skew, and you have uh, better or worse volatility, whether you're right at the money at a certain strike or if you're in puts versus calls. I tend to stay more with the puts as opposed to the calls, just because of
Yeah.
risk reward profile of them as well. But yeah, if you have anything interesting, maybe worth sharing that for like sort of beginner, investors that may think about wanting to get exposure to some of these call or put options, whether it's through like an ETF or just their individual stocks.
Yeah, so actually, that's a very good point because besides the VRP, the volatility risk premium, there's a so-called skew risk premium as well, meaning that there's volatility and there's skew. The implication is that if you sell put options, you can earn an extra return coming from the skew.
Yeah.
So it's like when you do cover call or cash secured put,
Mm-hmm.
maybe it's better to do cash secured put out of the money because this way you will take the advantage of the volatility skill.
Yeah, definitely. That's actually something we can cover a little later. I can pull up one of my articles. I didn't
Yeah,
get time to prepare slides for myself, but we'll go through your stuff and I can talk a little practical side about how I use the cash secured, the short puts, and we can talk about the calls and maybe why they're not the most optimal for investors. But obviously,
yeah,
there's uses for everything. Anything
yeah,
else you
yeah.
wanted to go ahead?
Yeah, so in this graph, I just showed the correlations between the VRP and then the returns on these S&P 500, and then the correlation is high, 0.75 for the past 10 years, but it's not one, meaning that if you do like a cover call or cash
But
secure put,
yeah,
you still have some diversification benefits in terms of the sources of returns.
and then on this graph, you have return is on the x-axis on the bottom.
Yeah, the returns is on the axis. Sorry, I didn't put.
Okay, well, that's okay. I mean, they're about the same values anyway. So.
Yeah.
Yeah, on both
Okay,
axes.
go ahead.
Next slide.
Yeah, next slide.
Okay.
So yeah, so as a beginners, investors who want to use options to enhance to enhance the returns.
Mm-hmm.
So as Kris just said, and then he's going to present more stuff after this. You can start with cover calls. Cover call is not the most advantageous. Strategies, but for beginners and then to get your feet wet, yeah, it's a good strategy to try. And then this strategy has positive expectancies, but the return distribution is not ideal. And Kris is going to discuss about this
Mm-hmm.
shortly. And then after the cover call, you can move on to what in the industry they call poor man cover call, which just means that you replace the stock by an in the money call options, and this way you can eliminate the tail risk. You can eliminate the tail risk, but not the risk. So you can say this option, this structure still has risk. But if your stocks or the market goes down like 20, 30%, minus 20,
Yeah, you could
20
lose
minus
all.
30%, you can still keep some part of your
Yeah.
capital.
Yeah, I think
And
it's. Can I just jump in for a minute there? Or?
yeah, go ahead.
So, and correct me if I'm wrong, but I mean, just the way thinking about this for especially more beginner investors who are still learning, and maybe applies to more experienced as well. But the poor man covered call, when you're, if I think you're buying an in the money call option, right, for some fixed premium, fixed price, well, that's a lot cheaper than buying the actual stock.
Yeah.
So hence sort of the poor man analogy, the metaphor. But that also does come with some risks that other investors may not quite understand as much if they're just getting started with them. So you can inherently get more leverage with that, which can be a good thing for your returns, right? You can really magnify returns. But with leverage, right, that always works both ways. So I think the important implication for people to understand, if you try something, which I don't personally do that, but if you try something like money calls, as Nam said, if the market goes the other way, you can lose all of that, right? So because you don't get the benefit of it if it's below the strike at expiration. So it's important to be aware of. You could potentially have more risk with this, depending how much money you're putting in. That you may not afford to lose.
Yeah.
So, but there is, on an absolute value basis, if you're wanting to invest 1,000 shares of some stock, you can express that with a much lower absolute dollar value by buying in the money call as opposed to buying the shares outright.
Yeah, exactly.
Yeah. So
yeah,
really
so
good.
Next step after the Pullman cover columns, if you keep it passive, but you don't have to. You can trade these options like actively by rolling, thus mitigating thus removing partially the gaps to the upside. But this is for like intermediate and advanced investors already.
Yeah, so kind of moving from one expiration to another, or one strike
rolling,
to another.
Constantly rolling.
Yeah.
And you have to watch for the deltas. And you have
and
to
there's
learn the Greeks and then how they vary
Yeah.
with the volatilities at time, things like that.
Yeah, then you get very multi-dimensional, more than 3D. And some basic practical, I think, experience for that as well. I can share. Some investors may relate to this. If you sell even a cash-secured short put, say you have, I don't know, pick an example on my screen, I guess, but you have like Domino's, right? It's trading at 460 or something right now. So if you sell a put at 400, well, that may go down, and it goes against you. And then what Nam's talking about, managing actively, is you close that out and try to sell again, and make that premium that you have to eat, and sell at a lower strike, like 350 or 360, for example. So but then there's more exotic ways to manage that more hedging, and people like, which is beyond the scope of this. But so it's interesting. So I don't know, anything else on that slide?
No. Next.
Okay.
Last slide.
Sure.
Yeah, so you can still use this cover columns as a foundation for and then modify it, modify the strategies to use some of its variants, at the more advanced levels. You don't have to write cover columns on all the stuff. you can write Capricorns on let's say high yield, high dividend paying stocks, or high beta or low beta, or growth stocks, or value oriented stocks. You do fundamental research, and then you enhance the returns by by doing the cash and secured puts or covered calls. If you have a portfolios of covered calls on let's say basket of stocks, then you can hedge this portfolio by buying index put options. And these are very advanced strategies.
Yeah, and there's a whole host of ways too. There's so many ETFs nowadays, right? Where different factors, or you have momentum or value. You have the different index ETFs.
Yeah.
Where you can where they also have income-oriented ETFs, and I could share an article on that too. But so you have all different ways to play these things. It's important to understand too. I think there's different ways to use the strategy. You have like JEPQ. A lot of people are look into that and talk about that. And you have other ETFs that use them and manage the risk in different ways. So if anybody has questions or wants to throw something in the comments or get feedback, I don't know I think if you're on X or Twitter, you're not able to do that. But if anyone's watching on the YouTube link, feel free to put any questions in there. Did you? What's the last one? Anything else you wanted to add, or we can move on to some of the articles?
We can move on if there's no questions. Then we can move on.
All right, so let's see. Let me switch over. All right, so here's I've only started the newsletter a couple months ago, but I mostly share my own analysis on investments I do, managing my own capital, but I also write different investing concepts or different approaches I have. And one of them is options, and that's kind of where Nam and I, we have this overlap where I think it was a good idea to put something like this together where we can discuss these. Especially he has some, more experienced technical insights on options and everything that, even better insights than me. So I thought we can just maybe go down. I didn't have time to make slides, but we can just kind of go down the article and I can just hit a couple of points and almost treat these like the slides. So Nav, if you have any thoughts or comments on what we're seeing or talking about, feel free to jump in too. Okay.
Yeah, sure. Go ahead.
But I have two different articles, so I'll just share this one first, and then the other. This one's I wrote on kind of optimizing yields with cash secured puts. So what I do is manage. I invest in individual stocks primarily, almost entirely. But a lot of times their stocks are a certain price that I may not want to buy. I'd rather buy at a lower price point. So I use cash secured puts to sell. Out of the money, a short put, right? So take that Domino's example, which I'm not invested in, but just an example. If it's at 460 and I believe, well, it's, 400 is the price I want to buy, then I can go find a 400 strike for a certain month expiry and sell a put for that. Obviously, meaning if it goes below that, I have to buy the stock at $400. If it stays above, I get to keep that premium, that income. So I use that as a strategy for my cash, to manage my cash. So I have about 40% cash right now, and maybe a third of that is in short puts, cash secured, meaning I'm not taking any leverage. So I have cash in my account to buy that stock if it's put to me. And the article, I'll just point out. I'm not going to go read any of it, but I'll point out some different points that I use and considerations. So, like I said, that point one is just cash yield optimization. And one important thing too, I found it depends on the brokerage account that you use, but I use Schwab to do this, and I use the money market funds. So that would be SNOXX, something like that, SDOXX, the Treasury money market. And you can, while you write these puts, you have to put collateral up to secure the cash. But with Schwab money market, you can actually keep your cash collateral in those money market funds. So I'm earning the 4.5% yield, right? And then if, I tend to look and get for about 12 to 13% annualized yield on the puts I write. It just comes out based on the delta I look for and et cetera, the IV. But so on those positions, on those puts, I get about 16, 17% yield. So obviously there's risk to that. Certain stocks can go down far below the strike, and I'll have to buy that stock and hold it for some loss at that point. But it's already stock I'm willing to buy at that price. So that's one caveat I'd mention is it's really important if you do something like this to make sure it's with a stock you're comfortable owning at a good price. And I know Nam talks about that as well too. It's understand the fundamentals and really know what you're what kind of risk you're taking on what stock. And then the second point is like strictly entry points really. So which I kind of already mentioned, but you can actually get pretty good premium when a stock actually has a bad down day or it dips or coming into earnings because there's more implied volatility. So you can pretty much get the same premium writing, the same premium at a lower strike. So you can get a better discount. I don't know. I'll stop there right now before I move down. Is there anything else, Sam?
No, I'm good. But when the stock has a down day, just make sure that the fundamentals of the stocks still remain solid. Like let's say, for example, like when we had the crash because of the DeepSeek announcement, right? And so
yeah, DeepSeek,
this will affect at most the AI sectors. But then, like if you have like stocks in the consumer staples, consumer discretionary sectors, they will not be like directly affected by this change in the AI technology. And then, but they went down to if the stocks goes down along with the market, then it's a good buying opportunity.
Yeah, definitely. And like we touched on too, implied. Actually, that's one of the next points. So, but a really good point, and I can kind of touch back on those too. The next section.
Yeah, and then Kris. But on the other hand, you just pointed out like a couple of days ago, like a PayPal after the earnings. Yeah. So maybe you want to discuss PayPal later, because it's earning related. So obviously there can be like some changes in PayPal's fundamentals. And then if the stocks goes down, then you should re-evaluate, or else you still want to hold PayPal for a long term.
Yeah, definitely. And if a stock has a big jump down, often there's a reason for it too.
There's a reason for it.
Yeah, it may or may not change your thesis on the stock. So you need to reevaluate and see if it still makes sense and whether you want to write a put on something like that. And PayPal, actually, thanks for reminding me. It's a good case study because recently they released earnings. Oftentimes before earnings too, you'll see the implied volatility is higher because of the uncertainty coming into earnings. You can get more premium that way. You can write lower strikes, but there's also corresponding risk with that because you could have a downside result and that'll really affect the shares negatively, and you may regret even writing that before earnings. So that's something to be mindful of. And what I noticed, Nam and I were talking offline yesterday, I think with PayPal, it dropped over 10%. I think it was 11, 12% it dropped after the earnings. When I own the stock, I think it's great long term. There's a lot I like about it. I think it's a bit overdone and it's a good buying opportunity. Obviously, you don't really know what's really going to happen in the future, but I try to put probabilities together in my head, and So the way I looked at PayPal this past week was the implied volatility didn't really spike up that much. I was looking in Thinkorswim, and it was still in the 25th percentile, 30th percentile for its historical implied volatility, right? So meaning if there was some real concern, that was very palpable, you'd more likely see a bigger spike in the IV percentile. It would be a lot higher than average.
Yeah.
That doesn't mean there's no risk there. I mean, there could still be downside risk, but I look at those kind of things as the bigger picture. Say, hey, that can be a potential bottoming, tactically in the mid 70s with PayPal. I mean, so far it's playing out that way. I mean, only time will tell, but it's in around 79 right now. So at the same token, you couldn't really write a really good option premium on that because the IV didn't spike. I could have written something around 70. I tried to do that, but I don't know. It didn't get the order didn't get taken. But that's a good example. And so on this next section on screen, the key factors. There's different things that influence the effectiveness of selling the cash secured puts, and there are just a few ideas of what I put together how to help approach it for maximizing returns. And we kind of talked about the implied volatility already. The other one, and Nam maybe can add more to some of these. You get into Greek, so we don't want to get too technical, but the duration of contracts, the maturity, right? And I think, Nam, you talk about probably like 1 to 3 months is probably the ideal time. To write some of this and take advantage of the time premium and the decay, right?
Yeah.
So, and that's what I tend to look at as well. If you look at charts, that graph, the theta and the Greeks, you have a really steep drop, a real decay and erosion of time value in that last month, starting about 30, 40 days out. So, but important to be aware is that the shorter maturity, the closer to expiration that you write, you're not going to have as much wiggle room, so you're going to have to write a lot closer to where the price is. So, there's corresponding risk factors to take into consideration with that. So, which actually it's sort of a sidebar, but makes me think about zero DTE and all of the 0 day.
Yeah, I'm thinking about that as well. Yeah.
And there's, I mean, that's become so popular with a lot of people. I don't know. I honestly don't follow it much. I know it's nothing I'm going to touch, but if you have anything, worth mentioning to beginning investors, if they start hearing, a lot of this talk about 0 date expiration.
Yeah, I mean, as you just said, when you write options near expirations, your P&L will be very volatile, and then if you are a sort of investors who doesn't like volatilities in their portfolio, then you should not do short-dated options. Like short-dated, I mean less than 1 month. And then 0 DT is at the worst in this sense. So the benefits of writing options from 30 days to 90 days is that you will get like a much smoother P&L in your portfolio. So you will sleep better, and then
I know there was an investor friend of mine was just telling me last week, friend of a friend or something that was doing these really short, I don't know if it was 1 day or maybe it was 1 week DTE, and on really volatile stocks. Maybe it was like ALAB. I can't remember the ticker, but and makes lots of money, but then also just recently got creamed, with the whole I don't know if it was around the DeepSeek time, maybe in January, but and so it's important to let people understand that because you hear 0 DTE all the time, and the closer you go, the closer you go to expiration, your tail risks are really getting pretty fat, I think, relatively speaking.
Yeah,
in some
because
ways.
the gamma of this option is very big, very
Yeah,
big.
yeah.
So
So
just the underlying moves a little bit, and then the gamma will change the deltas
definitely.
considerably. Yeah.
Yeah, I don't even know if 20 years ago I'd do that stuff, but I'm too old to even think about something like that nowadays.
Same here, same here.
Yeah. So the third kind of factor, option delta. So it's one of the other Greeks, as they call them. I think for more beginner investors, the way you maybe want to think about this is, and this is expressed in a percentage, right? So I say a delta of 0.15 to 0.25. That's 15% to 25%. If you look at it as percentages, it's sort of like the percentage probability that if you sold that option, that you're going to have to make good on it, and how likely it is to go in the money. And all of what I do is out of the money short puts. So when I write out of the money, I try really to do 15 to 20. I think is a real sweet spot for me on individual stocks. And the reason is you get under a 15 delta, and you can easily see these metrics if you're in any brokerage platform. But below that delta, you're just not going to get enough premium, enough yield to justify doing it, right? And taking that risk of getting the stock put to you. Anything more than like 25% delta, I mean, there are special cases. I think I could see I've considered maybe doing it, but it's more special case. The closer you get to a 50 delta and sort of at the money, as they say, you get more implied volatility, more premium, technically, theoretically. But anything over 25% delta, you're taking a little, you're getting more return, but it's not really worth the risk if you're selling cash secured short puts, right? I'm just thinking in the terms of being a long-term investor, looking to get extra yield on cash to pick up stocks at a lower price. So I know, Nam, you work with like all different, obviously very theoretical, the practical, you guys have clients and things. So, there's a lot more institutional and hedge traders. So obviously it's useful in a lot of ways. Just I'm not sure how practical and worthwhile it is for like a retail investor.
I think this rule of thumb is good, and that depending on how if you want to get the stock assigned to you, that you can go closer to the money. But if your goal is just to collect a premium, then this range is fine. And as I mentioned earlier, actually, besides the volatility risk premium, there's like a skew risk premium as well. And the skew risk premium is highest, like in the range of delta 20 or delta 30, depending on the stock, or depending on the index. You have to look for it, and it changes. But this rule of thumb is okay.
Good point. Yeah, definitely. And those are those special cases. If something is really beaten down, and you may be a little more aggressive and right at a higher delta. Before we move on to the risks, which we've kind of probably covered, but mostly the implied volatility. I just had another thought on that. Maybe useful is just escaped me now. Well, we'll come back to it. I'm sure I'll remember. Let's do the risks, and then I think that'll be it for this article.
So I have one more thought about the implied volatility. So
sure.
When you write the cash skill put on other stocks, so actually the implied volatilities of the stocks can be broken down to two components: stock specific and market specific. Meaning, sorry.
It's okay.
meaning
So while he's I had a oh, go ahead. You want to finish? I remembered my implied volatility point too, but you can finish.
yeah. So
You said there are two components to the
two components to the implied volatility. So, but for beginners, you just use the overall volatility. That's fine. But if you are an advanced investor, you may want to break it down to two components. One is the market implied vol, and then the other is stock specific implied volatility.
yeah. And then one quick point on implied volatility I remembered was if you're a more beginner investor, this may surprise you if you can't think ahead for it. When you write a short put for a stock, implied volatility it's mean reverting, but it can also be very volatile in itself.
Oh yeah.
Sort of yeah, it's kind of ironic, but implied volatility itself is very volatile. So for example, I mean, there are years can go by where implied volatility is 11, 12%. Sometimes if it's 20, 23%, I'm just using the typical VIX, right, that you'd see, but even though every stock has their own. The example I'm getting at is you can have a stock that's, say, 30% implied volatility, and that's pretty good. It's a decent percentile. I'm going to write my option. And then something happens and the IV spikes. Well, in your account, you're going to see a big unrealized loss on your short position. And now, as long as it doesn't go below the strike price, you'd be fine. You just collect that premium. You still don't have to buy the stock. But it does affect your liquidation to the net value in your account because of the change in the implied volatility. That option became much more expensive because the market is become more concerned about risk at the given time. So. Just a sort of a nuance, I think, is probably worth mentioning.
Yeah. So this is sort of nuance, and then you just mentioned that implied volatility, the volatility is mean reverting, but it's mean reverting in the long term. Actually, in the short term, day by day, when you have a volatility spike, actually volatility is sticky, meaning that a high volatilities will lead to higher volatility as well. That's why you see the dip during the COVID, for example. During the COVID crash, you see you just saw the dip in the VRP, volatility risk premium. Why is that?
Yeah.
Because when the market crash, volatility goes up, but it's sticky, meaning that high vol next day it will be higher.
That's interesting. Really interesting.
Yeah, and then counterintuitively, when the vol just spikes, it's a good time to go long volatility, not short, because of the stickiness of volatilities. But this is where like the very advanced institutional players they do. Yeah.
Yeah. You can. It's almost like it's almost a bit of a trend following quality on the very short.
Exactly. Over the long term, the vol will mean revert, but in the short terms, like a couple of days, it will be sticky. Yeah.
That reminds me of, speaking of the momentum and trend following, because you had an article on that. The dual momentum and things like Gary Antonacci, that's something we can do again at some point. I think that's something that would be interesting to discuss too, another call. But all right, so risks to consider. Some of these stock assignment, I think we kind of already covered that. But if you're selling a put and it goes below your strike, you're going to have to buy that stock. Another important consideration, and I deal with this is why I have cash, but this is why I don't have all my cash secured by short puts, because you can miss upside. It's one thing to get a 11, 12% annualized premium by selling Domino's puts below the current price. But if the markets keep going higher and I keep doing that, I'm going to be chasing and getting a smaller yield as opposed to participating in the upside of the underlying stock itself. So there's, like anything, there's no panacea. There's no free lunch. So there's always two sides to the coin. And third is the cash lockup. So the cash securing the put. And the way I like to look at it is sort of the flip side of the upside. It's the downside. So if you write a short put now, when the market crashes, well, you're still going to have to buy. You're going to have to buy that stock at whatever strike you committed to. Whereas if you didn't write the put, you can write an even better put, after that crash, or just buy the stock a lot cheaper than you could have. So there's always risks to consider. And then I get a little the history. I don't have to go into that, but I don't know how are you feeling now? We're at about like 50 minutes. Do you want to run through the other one on the like income oriented option income ETFs, or do you want to save that for another time? How do you feel?
It's up to you. But ask if the audience have any questions for us first.
Yeah. If anyone does, I'm not seeing anything. I imagine people are mostly viewing on X. But if anyone has any questions so far, or wants to see something, or things we can share later, please drop a comment. So I guess we'll take a little bit of time to go through the other article.
Yeah, go ahead.
And then we can stop there. Let's see if I can share this. I'm doing pretty good with it's the first time I'm using this app, so StreamYard, so it's going well so far.
Yeah.
All right, so this one, equity or exploring income-focused equity ETF. So I've written this one. I don't particularly buy ETFs myself to invest, but I do sometimes use them to generate ideas, things I may be missing, certain ETFs like factors for quality or buyback yield stocks, things like that. But there's a lot of ETFs that are focused on income using the covered call writing, right, which Nam talked about, and also some put selling too. But I think, and then you have these, like these yield max they're called. Are you familiar with there's these ETFs, they're like, yield max. It's like you take like something like Palantir or something, and you get like 60, 70% annualized yields. I can't imagine the risk you take for it, but there's all kind of varieties out there.
Yeah, I mean, I know Tesla, so they write cover call on Tesla, and then they distribute.
TSLY, is that TSLY?
TSLY, yeah.
Okay, that's one of those.
Yeah, they distribute like or they promise to distribute like 60% per year or something like that.
So what do they? I haven't looked at that one in particular. They're levering, writing.
I looked at it like last year, and then it cannot be sustainable. And I'm not following it, but it cannot be sustainable.
Yeah. I don't have time to look into it, but people ask me, and that's really why I wrote this article, because readers ask about this ETF, that ETF, and some of these are in here. So I have another one where I mentioned kind of the ones that I look at for ideas, but I'm not really invested in any of these, but it's probably worth just skimming through it for kind of beginner investors and intermediate ones. But and I put them into categories, right? So there's I have kind of the categories of these income-focused equity ETFs. So when we say income-focused, this isn't dividends. So I mean, this isn't like dividends as far as stock, right? You own Apple and et cetera, like on the S&P. This is income-focused to try to maximize, prioritize yield. Often using options. So the first one, covered call ETFs, and that's kind of what Nam went over earlier on in his slides. And I think a lot of people probably know what they are, but it's the flip side of puts, right? You're kind of selling, you're giving up the upside on the stock appreciation to get some income and yield. But at the same time, the reason we don't really, I think both of us, I don't want to speak on your behalf, but we both don't really prefer that approach, is because you retain literally the majority of your downside risk, but you're capping your upside risk. So it's sort of the opposite of like a beneficial kind of asymmetric return. But anyway, these are the covered call ETFs, and then you have JEPI, which I think is just the S&P, JEPQ, which I know is popular. They don't. I don't believe they use they write on most of the portfolio. I think it's maybe like 20% of it. But and another important thing is they use equity-linked notes. So these aren't really covered call options they're writing in the fund. These are actually over-the-counter agreements that the sponsor, the fund manager, is doing. So there's some other, and the article talks about it, but you have counterparty risk that gets introduced to that. It's rarely going to be, an issue. I mean, if we have another GFC, I don't, know that that's, and I'm not calling for that, but you can run in with big macro liquidity issues. You can run into that, but otherwise, counterparty risk, should be manageable. But it's you have the credit worthiness of that issuer. Global X has some of these covered call ETFs, and I think they may actually write at. So here's going to the other point: writing at the money calls, right? And why are they writing at the money calls? In part, you get more you get more IV there. So, and they're using exchange traded options. So some of the benefits, you have the high consistent monthly income, reduced volatility. Like Nam said, you're getting if your JPQ is on the NASDAQ 100, the NASDAQ 100 goes down 10%. Well, maybe you're getting a slightly smaller downturn with this fund because the covered call premiums offset some of that drop, but you're still mostly participating on the downside. So anyway, that goes through. You guys can look at the article if you want. And then the second category. So I guess some of these are dividend. I put in enhanced dividend ETFs where they selectively use options to boost income. So, on like blue chip kind of dividend payers. What else? I'm not really familiar with this one. I remember putting it in, but risk managed income ETFs. Trying to refresh my memory on this when I wrote this. Incorporate downside protection, reduce losses. I don't know. I don't remember that one too much. That's a small one anyway. But some downside. Oh yeah, so they're using puts.
Yeah, I mean, call is so they have like a portfolio of stocks, and then they buy protected put.
Mm-hmm. Yeah.
Synthetically, it's just like a call options, in the money call options, and then
yeah. So hey, these are a lot of, and then this is what you talked about. Here's Tesla, actually, TSLY, the high risk. I call them high risk, high yield ETFs. So
yeah, TSLY.
Yeah, and then I guess they have one for Apple. And
there's one for Apple as well.
Yeah, apparently. Yeah, I forgot. Yeah. So and I hear Kathy Wood's back in the news and such. She becomes popular again as some of these stocks take off. So, and yeah, I just right here. So stay away. I mean, everyone has just do your own due diligence. It may be for some people, but it's nothing I would ever recommend for this category. So, and then some of the benefits. I think that's the big. People are looking for high monthly income. They want yield. I mean, it's really a function. It's all because of the last 15 years we had ZIRP. I mean, we don't have it anymore now, but we had a 500 basis point increase. In a matter of like 15 months, took people off guard. But a lot of people, I think, have been trained to just look for yield with ZIRP. So it's a lot of these strategies end up being popular. So we kind of talked about all this, I guess, already. Capped upside, downside,
upside potential.
Yeah. So I think that's good for that one. So I don't know. I guess that's mostly. I think that's all I had. I'll put it on this screen here. We can just finish up, I guess, if you want. It's been just about an hour. And then maybe we can do another one if people are interested. If you have any comments later or questions for Nam or myself, you can we'll publish a recording of the video, and you can also reach out. And I don't know if there's anything else you want. Nam, we never really got to talk about a little about what you do. You want to tell them a little what you do with Harbourfront, with the newsletter, and just what you're up to in general.
Yeah, I mean, up in general, besides the newsletter, I I am a consultant, so I'm doing consulting for financial institutions and corporates, and then I'm running a hedge fund myself as well. So a lot of the research, quantitative research that I published in the newsletter, it has to do with the research for my consulting practice and the investment management business.
Sounds good. Yeah, you have some interesting research papers. I really like, well, reading some of the articles and the research. I just, I don't know, I tend to try to be a deep thinker, and I like looking into that. I can't analyze all that stuff on the quantitative level like you can, but I find it really interesting. And I also put a link to each of our sites, our newsletters, in the description in the YouTube video. So if you go to that, you can find out how to reach us there. And I guess we'll stop there, huh? Maybe we can do this again sometime.
Yeah. Okay. Thank you for doing this.
All right. Yeah. Thanks, Sam. Thanks everyone for viewing, for who viewed in. See you next time.
See you next time. Bye bye.